All right, welcome everyone to MBA 620. This is Project 4. We are in the spring 2020 semester. That means that most of you have survived through the first three projects, which is fantastic. Project 1, we explored economics, and that was, interesting. Projects 2 and 3, we covered accounting. In Project 3, that was a group project where you all had the opportunity to explore choice hotels as they compare to one of their larger competitors, Marriott Hotels, and you were able to analyze the financial statements through a comparative analysis. And you also explored concepts of costing and budgeting. Holy smokes, that was probably the toughest part of that project. And it always is, it really is. The reason why we had you go through these exercises is because as managers, we find that it's very, very important for you to understand how to interpret financial information and also to make decisions of that financial information. And it's also very important to understand how financial information is compared between two different companies. Now, why might you compare two different companies? One reason might be because you are one of their competitors and you want to understand where they are currently and how to gain a competitive advantage. Another reason might be you are looking to invest in multiple companies and you want to understand how they are competing with others. You might also want to understand that because you want to be a customer or you want to be a vendor for that company. So these are all different reasons why we go through these types of exercises. And this, for you as managers, you really need to understand how to analyze financial data as it relates to companies that are publicly traded. And so overall, the vast majority of the class did quite well on the group project. I would say most groups did quite well, comparatively speaking. I really enjoyed reading the reports. In my opinion, that's the most entertaining part about this course is reading the reports. Now, similar to what you did in Project 1 and Project 2, and here in Project 4, this is an individual project where you'll be completing a workbook just like you did before, and you'll be completing an executive summary. We'll talk a little bit more about that. But first, I want to show you the classroom. So this is where we're at. And I want to show you a couple of parts about Project 4, where to find some information. So you want to come up here to My Tools and go to Discussions. And coming down to Project 4, we have... Okay, we'll have your discussion, which you'll have next week on risk and returns. That's a fun one. You'll have recorded this video, which is being recorded right now, and you also have the PowerPoint presentation that I'm going to explore through this video, and that is in the discussion forum. Now I want to jump back onto the home page, and I want to go down to Projects, Project 4. And I want to go examine a couple of steps with you all just to kind of show you some good to know information where to find it. So step 1, toward the bottom of step 1, you'll be able to download the workbook that we'll be completing for this project. There are a couple of learning topic pages that are okay. Time value of money, present value, future value. These three right here, they're pretty good. They're okay. They're not the best, but I would recommend that you at least take a look at the time value of money one because it will help us to understand the concepts of corporate finance, which is what this project deals with. In step 2, these learning topic pages are probably not the best to help you, with the exception of probably corporate valuation. I think that first one will probably be okay. These other ones, they're okay. It's nice to look at, nice to read, but not super important. They're really there for additional information purposes. Step 3, the annuities one, definitely very important in step 3, annuities. I would recommend that you read through that one. These are the ones, again, good to know, not super important. Eventually, in project 5, these will come back into play, especially IRR, internal rate of return. We'll be talking about that. Real risk-free rate of return, that'll also come back. But don't worry too much about that just yet. And so that's it for the learning topic pages for this project that I wanted to quickly touch on before we jump into the project, because those ones I feel will probably be of some importance. Okay, so let's jump into the project, and I'll start by exploring the PowerPoint presentation I put together for the class. And you'll notice that the PowerPoint presentation relatively follows the project overall with respect to the various steps. I try to include only the really important stuff that you really should know in order to complete the project, in order to be successful. So as I had mentioned, Project 4 and also Project 5 have to deal with corporate finance, which is truly the larger bulk of what the vast majority of our students end up doing that go through this course and through the MBA program. What we find is a lot of students, after they complete the MBA program, they move on to become business analysts, or they'll become consultants, or they'll move on to become managers in various organizations at various levels. And so this type of project really does help from that respect. And you'll also notice that this project might also help you to better understand how things like loans are calculated. Actually, another interesting point is you'll get a good understanding of what mortgages and how mortgages work as well. It's an interesting project, to say the least. So the first step of this project is analyzing financing and investing activities. So what is finance? What is corporate finance? Well, in corporate finance, we discuss this concept called the time value of money. Time value of money. This is, how do I want to describe time value of money? Well, it's the idea that money is available at a present time is worth more than the same amount at a future time. What does that mean? You may have heard it's a very old saying. It's saying, a dollar is worth more today than a dollar tomorrow. And that's true. And the reason why a dollar will be worth more today than it would be tomorrow is because with that dollar today, I can invest that dollar. And when I invest that dollar, I earn this thing called interest. And interest is earned over time. It's very similar to the way your checking and savings accounts would work. Is you have money, it's sitting in the bank, and as it sits over time, it accrues interest. It should accrue interest. In most cases, it does. And so that's when we say, put your money to work, right? When you hear that term, it means to invest your money in order for the money to earn more money, right? Which is what we call interest. And so that's why we say a dollar today is worth more than a dollar tomorrow. And so that's the concept of the time value of money. It has to deal with the idea that money over time earns interest. And the opposite is also true. If I'm looking at retiring in 30 years, and if I retire in 30 years, I want to make sure I have X amount of dollars in the bank in order to live for another 20 years off of that retirement. And that's another concept that we'll explore in this project. So, formulas, yay! I know you're all so excited about formulas. Okay, so formulas. There's a couple of formulas that we need to understand, and this formula right here is what we like to call the time value of money formula. Now, the time value of money, we explore things like present value, future value, the interest rate, which is also known as a discount rate, but we'll get there, and the number of periods, which is the amount of time, okay? And so with present value, this is the value of the money today, hence the word present, the present value, how much money is worth today. The term future value has to do with how much the money will be worth at some point in the future, future value. The interest rate or discount rate, the interest rate is the percentage at which each dollar earns over time. So that's what interest rate is. And the reason why we say or discount rate is when we're working backward. Okay, that's why we call it discount. Interest rate is typically associated with present value. Discount rate's typically associated with future value. And we'll talk about that. And then we also have the number of periods. This can be expressed as days, months, or years. And so the time value of money formula is written as the future value of money equals the present value, or the amount that I'm investing today, times 1 plus the interest rate at which I'm earning to the power of the number of periods. And I'll show you some examples of what that looks like here in a little bit. But let's explore the formula a little bit deeper. And don't worry, you don't really have to express this formula on your own. You don't have to do the long math, as we say, or the old-fashioned writing it out. I'll show you some tricks in Excel that will show you how to do this. It'll save you a ton of time, I promise. Okay, so let's talk about present value and future value and all this. So time value of money. When we're calculating the present value is a matter of plugging in future value, interest rate, and the number of periods into the equation. And to figure out the opposite, to figure out future value, we just simply switch the signs. Well, as you may recall from earlier math courses that you may have taken some time back, when we change a sign from multiplication, when we're changing that sign, we're flipping the sign, as they call it, it converts from multiplication to division. And that's expressed in terms of compound interest. So let's just take a step back and understand what all this means. So when we calculate present value of a single amount, it's a matter of just combining all of the different parts that we've discussed, such as present value, the interest rate, and the amount of time. So to express this, the interest rate or the compound, to express this, what we do is we take our future value equals the present value times 1 plus the interest rate times the amount of time. This is for one, if we're just looking at one simple rate, okay? This is just one simple amount. However, if we're compounding it, we express it a little bit differently. Compounding interest is the concept of which interest earns interest over time. So think of it this way. If I invest $1 today and I leave that dollar in the bank for 1 year and my interest rate is 6%, that is 6 cents, right? And so I just leave it in, I leave it in the bank, okay? And at the end of that first year, I have $1.06. If I leave that $1.06 in the bank for another year, instead of it being $1.12, it becomes $1.18. And the reason for this conversion is because at the beginning of that second year, you've left in the amount, the original principal of the $1 plus the interest that had already accrued in that first year. And that's why we say interest earns interest over time. That's called compounding interest. It's where the interest compounds, right? And so to express this, we take our present value equals future value divided by 1 plus the interest rate to the power of the number of periods. So here are the things that we must know to solve these types of equations. The future value is the known value of the money at a declared point in the future. That's called future value. We got to know what the interest rate is or the discount rate is. And this is the percentage of interest that's paid out over each period. And of course, the number of periods. This is the amount of time that's expressed. So here's an example. Here's an example. It's a good example. I like this one. So here's future value. Now, we had said that it's 1 plus the interest rate to the power of n, which is time. Well, and when you're writing it out in the long ways, right, the old-fashioned long ways, this is how it's expressed. 1 plus I divided by n, which is also expressed as to the power of. So power of time times time, right? So let's look at this example. Let's assume that we're going to invest $10,000 for a period of 1 year, and we're going to earn 10% interest on that $10,000. Okay. So the first thing I do is I take my $10,000 today that I'm investing. So it says some $10,000 is being invested for 1 year. $10,000 is what I'm investing today. So I would plug that $10,000 into my PV, present value. I multiply that $10,000 by 1 plus the interest rate, which is 10% divided by 1 to the power of 1 year times 1 year. This is how we express the power of in long form. And so in a year from now, if I invest $10,000 at an interest rate of 10%, I should earn $11,000. Does it make sense so far? Hopefully.
Yes.
Great. Awesome. What's that? Good? Okay. All right, let's look at it from another example. Now, in this example, we're working the other way. We're working backward. So in other words, we're trying to find what the future value would be. Okay. Now, again, in order to find future value, as we had said a few slides ago, is that we would reverse the signs, right? We know that the time value of money equation is expressed as future value equals present value times 1 plus interest rate to the power of the number of years. Now, we express that what we do in order to swap the signs is we would substitute the future value with the present value and then divide by 1 plus interest rate to the power of the number of years. Now, let's look at it from this example. The formula can be rearranged to find the future sum and present value of dollars. For example, the value of $5,000 in 1 year from today, compounded at 7% interest, is, well, in order to figure that out, we again swap the signs. Okay, so future value. So basically I'm saying the value of $5,000 1 year from today is. Okay, so in other words, in 1 year from now, I want to have $5,000 in my account. My compounding interest rate is 7%. How much do I need to have in the account today? Okay, so I take my $5,000, my future value, that's how much I want to have in the account a year from today. I divide that by 1 plus the interest rate, in this case 7%, divided to the power of 1 year equals $4,673. So in other words, In order for me to earn $5,000 in 1 year from today, I need to have invested $4,673 at a compounding interest rate of 7%. Good so far? Yes, mostly. Okay. So now that we understand the conceptual framework of present value and future value, let's talk about this larger thing called net present value. Now, we talked about this concept of compounding interest. Now, as I had mentioned, interest earns interest on itself over time. The same concept applies with respect to present value, net present value. Think of it this way. A company every single year will have some type of net income, should have some type of net income. Or let's just say a gross profit, okay? Or not, yeah, let's say net income. So you have your cash inflows and your cash outflows. Your cash inflows are from your revenue. That's the amount of money that you have coming into the business. Then you have your cash outflows. Those are typically in the form of expenses. Your cash inflows minus your cash outflows equals your net cash for that time period, okay? Cash inflows minus cash outflows equals your net cash flow for that time period. Now, when we're looking at something like net present value, what we're doing is we're taking the sum of all of those net cash flows over a period of time. Okay. And so, when we're looking at evaluating a project, let's say we have two competing ideas. The company wants to build a factory, and the company is going to run a product line in that new factory. How do we determine if purchasing that new factory is a good idea or not? Well, what we'll do is we'll run out a sequence of net cash flows over a period of years to determine whether it's a good investment. And this typically involves having an internal rate of return or a desired rate of return over time to determine whether this project is worth an investment or not. And so typically if there's two competing projects, if the net present value is greater than 0, I would accept the project that has a net present value of greater than 0, because that means that at some point, not only will I break even, I will also be able to hopefully generate a profit in the future. So when we look at the concept of calculating net present value, the first thing we need to do is identify the amount and time of the cash flows required over the life of the investment. So in other words, if I am going to buy a factory and I expect that I'm going to make a certain amount of cash coming in every single year, how many years is it going to take for me to be able to break even? So that type of analysis will help me to determine whether it's a good project or not. So the first thing, again, is to identify the amount of the time that's required for the investment. The second thing I need to do is figure out what is my interest rate going to be. In other words, what's my internal or required rate of return? We also call this a discount rate or hurdle rate. This is essentially what I would expect to earn back from my investment. It's kind of like when you, if somebody loans you money, the reason why somebody would loan you money is that they would expect that not only you would pay back the principal, but also the interest. That interest is the reason why they lent you the money in the first place. That's what makes them money on their investment in you, right? That's why they call it interest. Interest isn't just a numerical interest. It's an interest in you, right? So the only reason why a bank is interested in you is so they can earn interest. Okay, that's the concept behind interest in a very general sense. So what the bank would do is they would calculate what is an appropriate interest rate in order to lend you the money. And you would do the same. The same concept applies when you're taking out a loan to invest into the company to expand the operation. What is the appropriate interest rate of which I should be paid back for that loan, right? So so what we do is we would calculate and evaluate the net present value of the investment, and if that net present value is above zero, then we would accept that project. Holy smokes, here's the formula for that. Whoa. Yeah, there's some Greek letters here. Okay, so let's break it down. And don't worry, again, these are really just for visuals and to help you get a grasp or understanding of the concept of the net present value. What does all this mean? So here's the first part of the equation. N, or the number of periods, is the sum over the time of 0 times the net cash flow divided by 1 plus the discount rate or the interest rate to the power of the time minus the initial investment. It sounds complex. Think of it this way. This is how I would determine what my break even is with respect to an investment. How my break even in terms of time, right? How long is it going to take me to get my money back? So I would say, okay, so the company's making this amount of money every month or every year, divided by 1 plus the interest rate at which I lent them the money to the time during the time of that particular time period. And I would express this going out. So how does that look in long form? You're probably asking. It looks just like this. So CFO is my initial investment plus cash flow at the end of year 1 divided by 1 plus the interest rate plus net cash flow at the end of year 2 divided by 1 plus the interest rate to the power of 2. The reason why power of 2 is because it's 2 years, right? Plus so forth and so on up until you've broken even. So this is the long form of figuring out how long it's going to take you to recoup your initial investment in a project. So that's why you would run something called the net present value formula, is to essentially figure out how long it's going to take you to get your initial investment back in any given project. So therefore, it's a really good formula. So let's look at it from an example. Don't worry, this is all long math, right? This just kind of shows you what it looks like in the long handwritten form, if you will. So here's an example. This company has even cash inflows, meaning it's taking in the same amount of money every single year. Calculate the net present value of a project in which requires an initial investment of $243,000. And it's expected to generate a cash inflow of $50,000 each month for 12 months. Let's assume that the salvage value of the project is 0 and the target rate of return is 12% per year. Okay, so salvage value. You may or may not have heard that term yet. So salvage value is essentially what is the project worth at the end of the useful life of the project. Oftentimes it's worth nothing, or it might be worth some scrap value, meaning, oh, I bought some equipment that is supposed to last 10 years. The project only lasted 8 years. Therefore, I might have a salvage value of 2 years over the useful life of that equipment. But yeah, but in most cases I'm sorry, I went too far ahead. In most cases, the salvage value is typically 0 at the end of that respective project. Target value or the target rate of return is 12% per year. That means I want to be able to gain 12% from the value of that initial investment year over year. So let's figure out what the net present value is. So here's what we would do. Initial investment is 50,000 plus 50 the 50,000 net cash flow divided by 1 plus 12% plus 50,000 divided by 1 plus the 12% to the power of 2 to represent 2 years, so forth and so on. You keep going. So here's how it looks in the, I guess, the long math, as they say. So you got your 50,000 times 1 minus 1 plus 1% to the power of minus 12 divided by 1, divided by 1% minus 243,000, which is the initial investment. And then if you could just condense all of this down, instead of showing you the long math, right, we should eventually get to $319,754. Again, it's a lot easier in Excel than it is handwriting everything out. But the reason why I show you this type of slide is to represent what it looks like in the long form if you were to write things out. Some of us are just a little bit more visual than others. I like to consider myself relatively visual from that perspective. And let's also talk about internal rate of return real quick. I had mentioned it briefly earlier. Internal rate of return is the also known as required rate of return. It's the rate of return that we use in capital budgeting to measure and compare the profitability of investments. If the net present value is greater than the internal rate of return, then we do the project. If internal rate of return is greater than 0, then we do the project. In context of savings and loans, which a lot of you are familiar with your banks, the internal rate of return is also called the effective interest rate. This is a term that this term internal refers to the fact that its calculation does not incorporate environmental factors like inflation. That's why we call it internal rate of return. It's our desired rate of return, or our required rate of return. It's something that we need or really, really want, but that rate is not influenced by external factors like inflation, deflation, a pandemic, anything else. It's regardless of those things, my interest rate is at the bank is the same regardless of what's happening out in the world outside. That's the internal rate of return. Okay. And of course, the one thing that a lot of groups had a little bit of trouble with when it came to the last project was understanding break-even. Break-even can be expressed in a couple different ways. It can be expressed in the number of units, which is what you learned about in the previous project, or it could also be expressed in the cost recovery, or also known as the payback period. This refers to the amount it takes to recover the cost of an investment. Simply put, payback period is the length of time of an investment reaches a break-even point. So let's take a look at the workbook. This is probably the more entertaining part of this mini lecture. That's what y'all came for. Okay, so project 4. This is your project 4 workbook. Again, you find this at the end of step 1 in project 4. Instructions, very short, sweet, and simple. Complete the questions. Okay, so let's start by the financing and investing tab. This is a fun project. So here's the skinny on it. McCormick and Company. For those of you from Maryland or from the area, you know McCormick. They are the spice company. They do all the dry rubs, all the spices, all the seasonings, all that good stuff. McCormick, they're huge. They're a worldwide company based right here in Maryland. Originally founded in Baltimore, currently just north of Baltimore, still in Baltimore County. The company has been expanding, as you might expect, and they recently looked at some land in Largo, Maryland, which is south of Baltimore. It's actually outside of the DC Beltway. And so the company was recently looking at a piece of land that was 4.35 acres that's zoned for industrial. The list price of that land was $3 million. And it's just the land. There's no building on it. It's just the land. Okay. The company does eventually want to build on that piece of land, but first they got to figure out whether the investment is worth it or not, right? And so a couple of ways that they do that. First, they run out their time value of money equations. They look at some loan options, because of course they want to protect their number one asset, which is their cash. And they also want to figure out whether the project's worth it. And we'll get to that point here in a little bit. Okay, so we got some data that's given to us. The company wants to purchase this piece of land for $3 million. But here's the thing, there's another company that is also interested in the same piece of land. So this other company, who's not McCormick, has made an offer for $2.3 million. Because hey, why not? And they'll also pay $300,000 each year for 15 years for the piece of land. Okay, that's interesting. And then McCormick, of course, comes in and says, well, hey, instead of taking that ridiculous offer, which of course, time, sure, but I'll just give you $4.424 million, which is well above the asking price of $3 million, right? And so we have these pieces of information. The land's for sale at $3 million. This other company came in and said, hey, we'll offer you 2.3 and $300,000 for 15 years for the land. Okay. And then McCormick says, you know what? I'll offer you $4.424 million in cash up front. Okay. Now, the landowner has to make a decision between these two offers. You have one offer that's below asking, but pretty much a guarantee on payments for 15 years of $300,000. And then you have McCormick coming in at 4.424 up front. So the landowner goes to his bank, and the bank says, hey, listen, whichever offer you take, we'll give you 12% interest on your account. Hey, that sounds great. Okay, so now we got to figure out which offer is better. Okay, so here's what we do. It says for question one, says, what is the future value of each offer? Okay. Now, toward the right, I gave you a nice little chart to fill up. So N, what is N? N, we know from looking at our PowerPoint presentation, is the number of payments, number of periods. Well, it's one. It's one for McCormick, okay? And in theory, it's 15 for this other company, right? Okay, so the interest rate. Well, the interest rate is 12%. The bank said the landowner will get 12% on the amount that they put into the bank. Sounds great. Now, the first company, the present value is $2.3 million. Okay. And McCormick said, hey, I'll give you the full 4,424,000. Give you that full amount right up front. So, okay, the payment, future value. Okay, so Dr. B, how do we figure these out? Okay, so now let me show you this really, really cool thing in Excel. I'm going to show you the payment function, and I'm going to show you the future value function. So let's go payment. So there's this little button up here, says FX. That means function. Click on that. And if for me it shows up right away because I clearly use it a lot, but if yours doesn't show up right away, just go to your search box and type PMT for payment. And click go, and there it is. It's PMT. Click OK. Now it's asking for a couple of pieces of information. The first one here is rate. Okay. So we got our rate. Our rate is 12%. The number of periods. For this first one, it's 15 years. Present value is 2.3 million. Okay. You'll see down here it says minus. In order to change that sign, if you just put a minus sign out front of the present value, it turns it into a positive. Because clearly the payment's got to be a positive number, right? And the future value is not known, so go ahead and leave that blank and click OK. Now, of course, it's going to be different for McCormick because, well, the number of payments is different. So back to future value, function, PMT, the rate, 12%. The number of payments is 1. Present value in this case is 4 million. Go ahead and pop that negative sign out front. That looks nice. Holy smokes. Looking good. Looking good. Okay. Now, you'll notice I just put 0 in terms of future value for this. Reason why? It's just one payment. It's just one payment. Okay? So there is no future value. This technically would be the future value. Okay? That would technically be your future value. But the reason why 0 here is because, again, it's just happening the one time. Okay. But that's a different case for that first offer because, as you see, it's 15 payments over the course of that 15 years. So let's go FX. And we want to find this thing called future value. So we go FV, click go. FV, there it is, future value. Okay, now you see it's asking for a subset of information again. First thing is asking you for the rate. The rate, as we know, is 12%. Number of payments. This first one is 15 payments. The payment amount, $337,000. Again, we want to make that negative. Then click OK. Now, here's the thing. Here's the thing. It's interesting. It's very interesting. Okay. Here's why it's interesting. We got the first company is offering 2.3 million up front, and then 300,000 for 15 years thereafter. Interesting stuff. Okay. That's great. Okay, that's wonderful. In fact, it's a kind of a tough decision, really. But then you got McCormick coming in and saying, hey, man, here you go. Here's your 4.424. And I decided to leave it in the bank for a year because, hey, 12%, 4.954 looks pretty good for the future value. Now, here's the interesting part. Which offer is better? Which offer is better? Well, well, here's the thing. Earlier, I had said, and time value of money. In the very beginning, we discussed this concept. We said $1 is worth more today than $1 tomorrow because of the amount of interest it earns over time. And the same can be said with this situation. So here's the thing. Okay. So question 2, it says, based off of your future calculations, which offer should be accepted? Well, if $1 is worth more today than $1 tomorrow, I'm going to go with McCormick's offer. Makes most sense. Because, of course, I can invest that money. And here's another way of looking at it, okay? Look at this. Look at these payment amounts, okay? Great. You give me 2.3 mil up front. Wonderful. Plus, at the end of that first year, you're going to give me another 337,000. That's nice. But that's nowhere near the same amount that McCormick's giving me up front. So let's say I left that amount in the bank for 15 years, which, you know, I don't know who's doing that, but you never know. So rate, number of payments, same amount of time, payment amount. We can already make a determination here that clearly McCormick's investment looks much better to me. But again, you might think otherwise. And so question 2 is relatively open-ended, but at the same time, you know, if you know that $1 is worth more today than it is tomorrow, then, you know, clearly McCormick is the better response. But what do I know? You know, that's just my opinion. So I'll take that for what it's worth. Okay, so that's question 2. Question 3. Question 3. So here's the thing. McCormick, yeah, I'm sure they probably got the cash. You know, 4.424 ain't much for that company. I guarantee that. However, most companies don't like to spend their cash up front. Cash is a very valuable asset for most businesses. So the company's deciding to borrow some. Why not? So here's the thing. The company's got needs $4.424 million for this acquisition. The company's decided, you know, it needs to borrow some. So what we're going to do is the company, according to loan-to-value rules for commercial loans. Loan-to-value means the value of the property with respect to the amount being borrowed. That's loan-to-value. That's banker talk. And with loan-to-value, the rules for commercial use loans is the maximum can be 70% borrowed to the value of the property. So so let's say we made the offer for 4.424. 424,000. Okay. So price 4.424. I need to put a percentage down and the rest I'm financing. So if I am going to put 30% down and finance the rest, right? Because it says that, you know, I need to borrow 70% of that 4.424 amount, which means I need to put the other 30% down. It's got to equal 100%, right? So you take equals your 4.424 times 0.3. Oh, that's not how I wanted to express. I apologize about that. We wanted to express obviously in currency. So that's the amount that I'm putting down. It's 30%, which means I'm financing the rest. So equals 4.24 minus the amount that I put down, and there you have it. There's your question 3. Question 4. Okay, so there's 3 loan options here that is being offered to me, which is fantastic. I got a 20-year, a 10-year, and a 15-year. Oh, and by the way, if you ever refinance your house or your student loans or anything, I recommend that you do this type of exercise because this will help you to understand if the payment amount fits your budget or not. So loan A is 20 years, loan B is 10 years, and loan C is 15 years. Okay. Now I'm going to show you something with respect to these number of payments. Yeah, I'm going to show you something with these payments because I don't want you guys to get tripped up. Here's the thing. We said 20 years, we said 10 years, we said 15 years. Yeah, kind of. But here's the thing. Question 4 says, which one will have the lowest monthly payment? This is clearly annual. 20, 10, 15. Those are years, not months. So what do we need to do? We go equals 20 times 12 equals 10 times 12 equals 15 times 12. This is now it's expressed in the number of months. Okay. Make sure you do that before you go through this question in order to get the correct monthly payment amount. Now, also monthly, here's the thing. The interest rate is expressed in annual terms. For loan option A, 20 years, 6% a year, 4.5% a year, 5% a year. So how do we fix this? We go equals. How do I want to do this? We do 0.0, well, I guess we could probably express it both ways. It should be the same. 6% divided by 12 months. Did that come out right? I don't think it did. Yeah, I guess so. Yeah, it's about right. That's right. That's right. I'm sorry. Okay. I just want to make sure it worked out right. I don't want to show you the wrong stuff. Sometimes I get tired. Okay, so next one, 4.5% equals 4.5% divided by 12. That's right. It's nice to kind of just show you what it looks a couple digits out. You don't have to, but it just makes it look nicer. It's better to be precise than general when it comes to showing your work. Just my opinion. 5% divided by 12 months. Clearly it's not 0, we know that, so come out 2 digits, 0.42. Okay, that's correct. Now present value. Present value, again, I showed you that this fancy FX thing. You could come down here, you go PV. Go, here it is. Okay, now it's asking for the information. You don't have to worry about dividing it here because we already did that here. If you didn't do it here, you could do it here, but we already did that for you. Okay, so rate, interest rate, bam. Number of payments, bam. Payment amount, oh, we don't know payment amount. We don't know payment amount. We don't know payment amount. How are we going to figure out present value, right? We know it's not 0. So let's figure out payment amount. So let's go payment, FX, PMT, rate, number of payments, present value, rate. Oh, sorry, that's not rate, that's number of payments. Rate, number of payments, present value. Oh, it's giving me that fancy error. Why did it do that? All we can do is 0, right? That's not correct. What did I do wrong here? What did I do wrong? I must have done something wrong. What did I do? Oh, you know what? That doesn't look right. What happened here?
So, Professor, just a wild guess for the present value. Isn't that the amount financed? That $3 million?
Oh my goodness. You are so correct. Oh my goodness, look at me. Holy smokes. I feel so silly now. Thank you for pointing out the obvious that I probably should have known. Yes, you are correct. It was so strange I was drawing a blank on that. You're absolutely correct. Thank you so much. I appreciate you pointing that out, Giselle. Okay, so let's try again. So payment. Okay, the rate. Oh, I did it again. Look at my silly self. The rate, the number of payments, the present value, the payment. Oh yeah, that's looking a lot better. Nice work, Giselle. I appreciate you pointing that out to me. Put the minus sign in front to make it positive. Bam! That's correct. Yay! You can also do the fancy Excel thing if you want to drag and drop it down like you've done before, or just keep doing it. It's good practice also, by the way. PMT, the rate, the number of payments, the present value, amount being financed. Of course, it's the present value. Oh, goodness. Oh, me, oh, my. Look at that. Amazing. It would have been the same, right? Oh, yeah, it sure would have been. Okay. There you go. Boom. Nice and easy. Now, the question said, which loan will have the lowest monthly payment? Well, monthly payment, lowest monthly payment, looks like option A is the winner. So option A, boom, just like that. Question 4 done. Question 5, which loan will have the lowest total payback amount? Ooh, that's a cute question. I like that. Okay, so here's what you can do. I like this. Watch. This could save you a lot of time. Copy. Paste. Just paste in. Oh, that did not work out proper because of the formatting. Look at that. Boom. Okay. Then what you do, total amount paid equals your monthly payment times the number of payments. Drag that down. Boom. Okay. Lowest total payback amount. It's going to be this middle guy right here. Fascinating how that worked, right? You're saying, well, that's it. To me, that's interesting. Here's why it's interesting. Did we expect loan B to be the lowest total amount? Maybe, because it just so happens to be the shortest amount of time and the lowest interest rate. Okay, all right, that's fair enough. Do we expect loan A to have the lowest monthly payment amount? Maybe not. I mean, we could see it's really close to loan C's option, which is interesting. It's a difference of 5 years, but only a difference of $2,000 a month. So fascinating stuff. That's why I like this particular project. Is you can really look at this not just from a business perspective, but also a personal perspective. Like, again, if you're looking to refinance a mortgage or something like that, you can run this type of exercise out, and it really is applicable to these types of loan decisions. So just a really, really interesting and fun project, in my opinion. And then question 6, what would you recommend McCormick Company select the loan with the lowest payment or the lowest total payment, and why? Ooh, that is a great question. That could be a personal question. That could be a business question. It depends. It depends on the business's cash flow. So if the objective of the business is to protect cash flow, cash being, of course, the most valuable asset the company has, then, of course, the lowest monthly payment would work best, because that means that the company would be able to leverage the rest of its cash otherwise. However, if the company is debt adverse, then maybe a different option would be better, which would be the lowest total payment. So it's just a very interesting discussion. With that one, you just make sure that whatever option you choose, whether it's the lowest monthly payment or the lowest total payment, that you justify your reasoning for that selection. Again, it could be the company is interested in saving cash, or the company is interested in getting out of debt faster. Whatever that reason may be, just make sure that you support your logic. Again, and you might want to do this by doing a little bit of research on the company. You could look up their 10K report and take a look at their statement of cash flows to give you an idea of what their cash position looks like to support your answer. Or you could just do some simple online research. But regardless of how you answer question 6, just make sure that you support your selection with logic. So any questions on that first part of the project? Is it hopefully very straightforward for the most part? I think it'll be fun. I think you'll enjoy it. Okay, great. Let's go on. Okay, so we talked about time value of money, which is one of the most important concepts in business, in my opinion. Now let's talk about corporate valuation. This is the valuation of company performance. So let's talk about these fancy things called stocks, bonds, dividends, returns, risk returns, all that good stuff. A dividend. A dividend is something that's paid out to stockholders, shareholders. It's usually a form of a payment that is distributed to shareholders or stockholders on a regular basis. This is called a dividend. It's a small payment for your ownership in the company. Regular people like you and I could have dividends. We could earn dividends by owning shares of stock in companies that pay dividends. Like General Electric, they used to pay a dividend for a while. There's a couple of other large companies that still do pay dividends, believe it or not. Up until recently, Marriott was one of those companies that paid a dividend. There's a couple of other large corporations out there that still pay dividends. Dividends are another ways of, in my opinion, a dividend is the most attractive way to attract new investors. By offering a dividend. That is a very attractive way to attract new investors, new cash, as we say. So it's basically a way of paying back your stockholders without actually buying back the stock, right? And so what are stocks? A stock is a form of ownership in that company. You, I, and everyone else, we own a whole lot of companies. You don't think of it that way, though. But if you have a 401k or any other type of retirement account, there's a good chance that there are shares of stock in your portfolio. We typically group those together in what we call mutual funds. These mutual funds typically have a large plethora of various stocks within each mutual fund. And a stock is a form of ownership in that company. It's very, very small percentages, of course, and they typically don't have voting rights. Some of them do. But a stock is a form of ownership in a company. There's common stock and there's preferred stock. Common stock is a very common way of owning shares, which are typically done through retirement accounts, which most of you probably do have. It carries voting rights and is a form of ownership in the company. Preferred stock, these typically do not carry voting rights, but they do have priority when it comes to liquidation over some type of event like bankruptcy or anything else. The way to think about it is common stock is commonly available to the public, and preferred stock are typically reserved for the original owners of the company or the board of directors or the employees of the company. They typically have preferred shares of stock. And many, many years ago when I was a barista at Starbucks, when I first started out in that space, and then I moved my way up to assistant manager in a short amount of time. This was many, many years ago, okay? Back then, they used to give us shares of stock as kind of like a bonus or a gift. It was kind of cool. I enjoyed it because it was just fun. It was different. I don't know if they still do that. Maybe, who knows? Okay, so if you're ever on the open market, on the stock market, you can buy and sell your shares of stock. When you buy something on the exchange, we call that a call option. A call option. You're calling it out of the marketplace. That's why it's called a call option. And then if you want to sell a share of stock, it's called a put option. You're putting it back into the marketplace. These are just terms that are widely used to express the buying and selling of stocks or bonds or other types of exchange mediums. Now, here's the thing. With any type of investment, whether it's corporately based or not, there is risk involved with investing. We all know this. There's a whole lot of risk out there. There's risk and return. But foremost, there's what we call risk. This is inherent risk in the market. Risk is in the economy is an essential component for the return of an asset investment. There's a lot of different types of risk that we know of. There is credit risk. That means the credit markets may not be able to lend money to corporations because they're highly leveraged, or they are loosely available and they can lend as much money as they want to. But then there's that credit risk, liquidity risk. They might not be able to pay you back, right? We'll talk a little bit more about this when we get closer to our discussion. But just think of risk as being risk associated with any type of investment that you make in the marketplace. Now, of course, when you make an investment, oftentimes you'll get what's called a risk premium. Because you're making an investment and it's inherently risky, we can mitigate that risk or protect that risk by charging what's called a risk premium. In other words, you might get a higher percentage interest rate than you normally would because it's a riskier investment. And in order to mitigate that risk, they'll give you a little bit of extra, also known as a premium on that initial investment. Risk premium. Now, returns that's what we get back from our investment. That's a return. It's a way of getting paid back, and that's usually expressed as a percentage, also known as interest, plus, of course, your principal. That's expressed as return. And of course, if you lose money, it's called negative return, but hopefully we don't lose money. Okay, so when we're talking about valuing companies or making corporate valuations, we utilize this fancy model. It's called the capital asset pricing model. It's exactly as it sounds. We're valuing the company's assets. Okay. So the capital asset pricing model is a method for determining the appropriate discount rate, also known as interest rate, in business valuations. The capital asset pricing model derives the discount rate by adding the risk premium to the risk-free rate. In this instance, however, the risk premium is derived by multiplying the equity risk premium times the beta, in which the stock price volatility. Another way of thinking of CAPM is this is how we figure out how much a share of stock is worth in the future. The beta, you heard me say the word beta. The word beta means systematic risk. And the beta is widely published information. This is the risk in the environment. or risk associated with that particular industry for a similar group of companies. The beta represents the percentage of systematic risk with that investment. That's what the word beta means. Beta means risk, percentage of risk. So let's look at the capital asset pricing model from a perspective of the formula. I know you guys love formulas so much, so I figured I'd throw another formula at you. So here's the capital asset pricing model formula. The expected return on the investment, this means the value of the stock or the value of the company, the expected return on the investment, okay, equals RF, the risk-free rate. Risk-free rate means the rate at which risk does not exist, although risk always exists. So it's kind of a stabilizing figure. There's a lot that goes into that number, but just understand that the risk-free rate is a way of kind of understanding the stabilization of the market or stabilization of that company without risk being associated with it. And this typically results in the value of assets. Plus the beta, which is the inherent risk within the marketplace, times RM minus RF. RM is the expected return on the market minus the risk-free rate. Don't worry, I'll show you what that looks like in the project. So we talked about risk-free rate. What is risk-free rate? So risk-free rate is risk-free. It's the interest rate at which there's no risk. That's why I said it's like the valuation of the assets. There's no risk with those assets, which is also expressed as your interest rate without risk associated with it. So on a debt instrument that has zero risk, it means that there's no risk for default or reinvestment risk. So to calculate the risk-free rate, we take 1 plus the nominal risk-free rate divided by 1 plus the inflation rate. Inflation rate is a government rate that is published. The inflation rate means the rate at which the value of a dollar is increasing over the economic growth. That's called inflation rate. Right now we don't have that, so not much to worry about there. Okay, and then so we talked about the capital asset pricing model. There's another model I want to discuss real quick. It's called the dividend discount model. This is a way that we value a firm at a discounted sum of its future dividends. In other words, this is how I determine how much this stock is worth in the future, or how much it currently is worth. I would calculate what's called a dividend discount model. Sorry about that. I hit a button. Okay, so what this helps us investors do is this formula helps us to understand the true value of the stock, the performance of the stock for the company. And so to calculate this, we take the value of next year's dividend, because the company every year publishes how much the dividends will be for the following year. Value of next year's dividend divided by the constant cost of equity, meaning how much the cost of financing is, minus the constant growth rate. And so let's go ahead and look at our workbook, corporate valuation. And I did point out these learning resources in the classroom, and again, they're nice to read through, but at the same time, you don't really need to know a lot about them. It's just kind of for informational purposes, because what I've done here is I provided you the formula, and you're just basically taking the information from here and plugging it in order to find out what the equals is. So for this first question, we're trying to figure out McCormick's value, right? And we're looking at it from the capital asset pricing model, as well as the dividend discount model. So the first thing we want to do is look at the capital asset pricing model. Now you got a whole bunch of information up here, and it's just a matter of plugging it in to figure out, okay, so how much is the stock worth using the capital asset pricing model. So RF, as we said, was the risk-free rate, and the risk-free rate, after you've read through all of this lovely stuff up here, the risk-free rate using the 10-year Treasury note, we said is 2.03. These are not, one thing I should say about the risk-free rate and also the beta, the risk-free rate and the beta are not expressed as percentages. So just take that in stride, okay? So just the number is okay. And why did it do that? So 2.03 is the risk-free rate. The beta is 1.35. Again, not a percentage. I don't know why it went in red. That's kind of weird. But I mean, it's not a big deal, but I like to be consistent. And the market rate minus the risk-free rate. The market expected return on the market, 8.03%, equals 8.03% minus our RF 2.03. Yeah, that can be. Huh. That was kind of weird. Oh, I did that. Okay. All right, so equals risk-free rate plus. In this part, you're going to want to do those fancy brackets. And the reason why is because you're multiplying this guy, the beta, times this guy here. Something doesn't look right here. And you know what? I think because our expected return on the market is expressed as a percentage, it threw off the sign for some reason. Oh, wait, no, yeah, I'm right. Okay, so leave it as go ahead and leave that risk-free rate as a percentage, 2.03%. And the reason being is because in order for the return on the market minus the risk-free rate to yield a positive number and to just make it clean, leave them both as a percentage. I mean, technically, you could just convert the 8.03% into a decimal, and that's fine. But just for simplicity's sake, just kind of leave this as 2.03%. It's fine. It'll be okay. Because we should yield the same result. So 1.35 for the beta. And let's do this. So equals 8.03% minus my risk-free rate. There we go. That's a lot better. I don't know what was going on with that other one. Equals 2.03% plus, open parenthesis, beta times return on the market minus risk-free rate, close parenthesis. Yeah, much better. Yay, we got there. Okay. So this 10.13% shows us using the capital asset pricing model what my required rate of return is on the issuance of stock. So what does this mean? Every time the company issues a share of stock, the company's overall performance value increases 10.13% for that next respective year, which is actually pretty good. It's a pretty good rate. Because the reason why I say that is because if you benchmark this 10.13% against the S&P 500, which is where the you'll find McCormick and Company. The S&P 500 index in comparison to 10.13% is good. It's good. It's about on par with the S&P 500. So that's how I would look at this stock performance as it relates to required return from the issuance of stock. So just my 2 cents on that one. Okay, so let's look at the next question. So we're looking at McCormick with respect to the dividend discount model. This is also known as, and I should have said this before, the dividend valuation model. Most commonly known as the dividend discount model, DDM, also known as discount valuation model. The formula here, as we said, was next year's dividend divided by the price per share plus the the next year's dividend discount model divided by the price per share plus the growth rate. And so here's how this looks. So we got our next year's dividend per share next year is $2.28. 28 cents, sorry. Divided by our price per share, $155.70, plus our constant growth rate is 8.7%. And with this formula, it's nice and easy. You go equals this guy plus this guy. And there you have it, 10.16%. Now, interesting fun fact. You'll notice it's pretty close. It's real close. The capital asset pricing model in comparison to the dividend valuation model, we're really close. We're 0.03% off. The reason why that type of thing happens is because we're using different models that take into consideration risk differently. So realistically, the capital asset pricing model is a little bit more exact in terms of valuing the company's return on the market. It's a little bit more exact because we're taking into consideration risk, some variation of risk using the beta. Without that beta, I mean, you're going to be really close because, again, the dividend valuation model really does not take into consideration the concept of risk. So it's just a really interesting comparison to make. And that is step 2 of the project. On to step 3, evaluating assets. So annuities, let's talk about annuities. So an annuity, most of you probably already know what it is. It is a regularly scheduled payment that's made over time. Now, an annuity could either be a payment to you or a payment that you're making. And it's the same amount, the same interval, meaning the same amount of time, and it's scheduled for a specific amount of time. Now, an example of an annuity, a payment that you make every month, is your mortgage payment or your car payment. These are annuities because they're regularly scheduled, they're due at regular intervals. Those are called annuities due. Then you have ordinary annuities and perpetuities. An ordinary annuity is expressed as the payment that's either sent or received without condition. And then perpetuity means it continually happens over time, and there is no end. Perpetuity. That's why on Shark Tank, you'll hear Kevin O'Leary say, I want you to pay me in perpetuity. When he says that, it means forever, right? Until the end of time, or until the end of something happening, right? That's a perpetuity. But it's still an annuity. It's still a regular scheduled payment, usually the same amount over time. And annuities help both creditors and debtors to be predictable when it comes to cash flows. Now, we can use present value to understand what the annuity payment or what the annuity payments would be. And you can see here it says use PMT function in Excel. Okay. So going back to our workbook, to the annuities tab, here's two really awesome questions. Okay, so there's an employee at McCormick is scheduled to she's going to retire at some point. Says that she's determined that she needs about $5,000 a month in retirement over 30 years. This is what she needs to have coming in. Okay. She forecasted that her money will earn about 7.2% compounded monthly. And she will spend 25 years more working toward this goal. And her at an annual savings rate of 7.2%. Should this employee make should her monthly payments how much should her monthly payments be during her working years in order to satisfy her retirement needs? And it says, hint, find how much Mary must have in retirement, then find the monthly payments to reach her goal. What is the maximum amount Mary could withdraw for each month so that her dollars never decrease over time? So that's question one. So for the first part, we need to figure out, obviously, how much her monthly payment should be. And the second part, we should figure out in perpetuity, how much it should be over time. And then the second question is, if she's moving, considering another job, looks like she's got some mortgage options that she's looking at. Let's see. She's going to move to Maryland. This other employee is going to move to Maryland to take a job at McCormick. They plan to buy a house. Budget's $500,000. They have $100,000 down payment, which includes closing costs and all that good stuff. They're considering a 30-year mortgage at 4.5% or a 15-year mortgage at 4%. Calculate these out. So in this column, you'll figure out the first mortgage option, 30 years, 4.5%. In this column, you'll figure out the 15-year at 4%, and you'll figure out which one will be best. And it says property taxes and insurance will add $1,000 per month to the mortgage, whichever one they choose. So you want to add that $1,000 in to each monthly payment. And that's the annuities tab. So those two questions should be mostly straightforward. And then the following week, after you submit your milestone for me to take a look at your workbooks, you'll have your discussion on risk and returns. As we earlier discussed, returns are known as the amount that you should earn for each dollar invested over time. It's usually expressed as a percentage interest. We'll talk about that in discussion, and we'll also talk about the various types of risk that are associated. There's a lot of different types of risk. There's asset-backed risk, payment risk, interest rate risk, credit risk, liquidity risk, market risk, operational risk, foreign investment risk, model risk. And you can probably add a couple other risks to these categories. These are all different types of risks that are involved when it comes to investing. Asset-backed risk means what happens to the asset over time, meaning a house. If the house burns down, there goes the asset. If the house is sold, there goes the asset. There's a lot of risk involved. Usually, a lot of investors engage what's called mortgage-backed securities. This is where they group a lot of mortgages together and securitize them in the form of a of mutual fund, and they'll invest on the interest from those mortgages. There's also prepayment risk. This is where you're like, you know what, I'm tired of being in debt. I'm going to pay my house off early. I'm going to pay off my car early, whatever it is. The bank loses money when you do that, obviously, because they won't be collecting the interest for those months that you paid early, right? So that's called prepayment risk. There's also interest rate risk. This is where interest rates can either be variable or fixed and change over time. There's credit risk or default risk. This is where the borrower stops making payments at a risk of defaulting. Liquidity risk, meaning the assets cannot be quickly converted into cash. Liquidity, as we discussed in previous projects, liquidity is the utilization of cash and how quickly we can turn things into cash. Like houses, how quickly can it be sold, turned into cash, so forth and so on. Market risk is the risk of losing your investment due to market decline, kind of like what we're experiencing in today's environment. Operational risk, that one's pretty obvious. We're experiencing that today. Operational risk deals with operations of a particular business. Sometimes there's a risk of a pandemic, which causes the operation to shut down for a temporary period of time. That's an operational risk. There's foreign investment risk. This is foreign investors, like from other countries, will come in and invest in companies and then go out of business, or something might happen overseas and cause other types of problems. Then there's model risk. This involves utilization of different types of models to predict the future. We all know predicting the future is next to impossible, but there's always a risk with that. And then in the last step of the project is your executive summary. And as you know, with your executive summaries, please, I cannot express this enough, be as analytical in your approach as possible. Your purpose, your problem, your methods of analyzing the results, and the recommendations. When you go through identifying the purpose and the problem, when you get to the methods of analyzing the problem, we want to talk about the tools that you're using in the project. For example, the capital asset pricing model, this discount valuation model, whatever it is, present value, future value, all that good stuff. These are methods that you're using to analyze the problem. The results of the analysis, these should be the numerical results from your project that demonstrate that are a result of your analysis, of you utilizing those tools in the project. Your recommendations need to be based off of your results, okay? They cannot be general, vague statements. Recommendations need to be actionable. It's kind of like you go to your boss and you go, all right, boss, here's a summary of what happened. Boss is going to be like, great, how do I fix this problem? Okay, you want to be analytical in your approach. Okay, boss, here's the problem. Here's what I did to analyze the problem. Okay, here are the recommendations based off of the analysis. Does it make sense? I hope so. Because that's the way it really needs to be done. That's the way it's done in business. And that's the way it should be done here. Are there any questions, comments, or concerns I can help to answer? Anything at all?
Yeah, Dr. B, I have one question. And
yes, please.
Refer all the way back to the workbook under the financing and investing tab. I'm still struggling with the first number one. I just want to make sure that I'm understanding how you built the formula and what we insert, because I come up with something different. So I just want, again, to make sure that I'm doing this correctly.
Yeah, absolutely. My pleasure. Great. So let's quickly go back through question one, and I'll show you exactly how it works. So question one, again, we're looking at the landowner is analyzing two potential investments. One is from McCormick for the purchase of the land, and the other one is from a competitor for the purchase of the land. The first option, the first offer that the landowner got was the the initial amount was for $2,300,000. That'll be your present value. The landowner has a bank account where it yields him 12% interest on the money in the account. And we were told that the company will, in addition to the $2.3 million, the company will also make an investment that will also pay $300,000 each year for 15 years. So 15 would be the number. And then the second option was from McCormick. They're making one cash payment up front. The interest rate is still 12% because it's the landowner's bank account. McCormick is offering $4,424,000 on the land. Okay. And now we got to figure out the payment amount and the future value. For McCormick, what we'll find is the future value doesn't exist. And the reason being is because with McCormick, they're paying everything up front. There is no additional payment after the 424 is in. So what we want to do here is under PMT, which is payment, we click on the FX button. We find PMT in our function list, or you can just type PMT. Click Go. Select PMT, click OK. The rate is the interest rate, 12%. The number of payments, and this first one is 15. The present value is 2.3 million. We want to put a negative sign in front of that present value in order to convert to a positive amount. Click OK. And I'm sorry, where was I? For the future value, FX, future value, click OK. Rate again is 12%. Number of payments is 15. The payment amount, put a negative outside of there. The present value amount, oh, actually, okay. So when you do your future value amount, we already know what the present value is, but we don't actually want to put it in. We want to omit it because the present value is not going to impact the future value of payments. Does it make sense?
Yes, it does.
Great. Yeah. So go ahead and just leave that one blank. That might have been why you're coming up with a different number. Okay, and then the payment for McCormick, just go FX, PMT, okay. The rate, 12%. Number of payments is just one time. The present value, 4424. Put a negative sign in front of that to make it a positive. Click OK.
Perfect, thank you.
Great, wonderful, Kia. Great, awesome. Okay, are there any other comments, questions, or concerns that I could help to answer for anyone before we call it a day? I hope this was helpful.
Professor, this is Shauna. For
Shauna.
question 5,
Yes.
What's the formula used for total paid?
Oh, for total paid? Yep. So that for the total paid it's the payment amount times the total number of payments.
Thank you.
You're very welcome. Wonderful. Okay, are there any other comments, questions, or concerns? Be happy to help. We're good. Again, you can always email me. You know how to get me. And the good thing is attempt all the questions just like you normally do in the workbook. if you can, try to make that milestone submission. And as always, I'll give you my feedback. And, should be good. These are the fun projects. I think you'll enjoy this one. Okay, so if there are no other comments, questions, or concerns, I would love to call it a night. And as always, I thank you so much for your time. And if you need anything, just let me know. I'm here for you.
Thank you.
All right. Thank you all so much.
Thank you.